Well, it was a bit of some disappointing economic news this morning. It is Friday, February the 20th, and this is Markets with Megan. If you like this podcast, you can subscribe to it. Hit that alarm bell. You can also share it with any friends, family, or colleagues that might be interested on that economic data that you see in the news headlines and what it means for your investments. Let's break down what we got this morning. First, we got the fourth quarter reading of GDP, and it came in much weaker than expected. The U.S. economy only rose 1.4%. Now, again, this is subject to revisions, but the first reading here is that it rose 1.4%. It was worse than the expectation, which was 2.8%. And just remember that a few weeks ago, the Atlanta Fed GDP Now model had showed that we may see growth of upwards of 5%. So much weaker than expected. It was primarily led by federal consumption. That was the worst quarterly drop since the third quarter of 2020. Remember, we had the longest U.S. government shutdown on record during the fourth quarter of last year. We also saw consumption, personal consumption, which usually drives GDP. It was weak, not awful, but it was the slowest since we had that first quarter drop in GDP of last year, primarily led by a decline in auto sales. CapEx spending continued to be strong, but it was primarily due to the intellectual property and specifically software and research and development. And when we look at net exports that have been in focus because of the tariffs, that was relatively flat. Now, alongside this report, we also got December inflation data. And the reason why we think that the data in general was disappointing is because we had a weaker GDP, but we also had hotter than expected inflation. So core inflation rose 3% on a year-over-year basis. It was 2.9. The super core, that excludes some of the volatile items like housing, that was up 0.3. On an annualized basis over the past 3 months, that core inflation is now up 3.1% versus 2.4% the prior month. And it's not just services where we saw the inflation pressures, and that has been a primary focus on inflation for a long time now, but we did see a big jump in the inflation on durable goods, and that could be primarily due to auto prices rising. So that's all that we have today. The markets were weaker on this because of the weaker economic trajectory. They've turned around today. We do have some news coming out from the Supreme Court on Trump's tariffs. We'll be back on Monday when we dig through all those details to give you some of our thoughts on what that means for the future of tariffs and as well as the markets. Thank you very much. If you want a history of our podcast, you can go to marketswithmegan.fm.